might be taking up a seat with my bag and coat if you want to rescue them so that people can sit down. Yeah, you just... Yeah.
Okay, if you could finish taking your seats, and we're going to start. Do we have Natalie online with us? Yes, very good. So let me welcome you to this event where we intend to discuss the issue of the economic consequences of climate action. So I'm Jean Pisani, I'm a senior fellow with Bruegel, but I'm also assigned to prepare a report to the French Prime Minister on this very topic. And we are with Alex Brazier, I don't know how you pronounce your name, okay, who is with BlackRock, formerly with the UK Treasury, I think. The Bank of England, sorry. So they've done also work on this very topic. And Géraldine Mailleux, who is Director for Structural Policies with DG ECFIN. And on screen, Nathalie Layani, who is, she doesn't seem to be hearing us. Do you hear? Can you hear us? No. Okay. A major delay. Who is director for environmental and climate policy with the Caisse des Dépôts in Paris. Okay, so so we agreed that we would just give very short introductions and then have a debate to the extent possible on important topics. So let me just tell you what I think is the state of the debate. I think we all agree that the climate transition is a major transformation. It's a sort of equivalent to an industrial revolution, with a key difference that instead of being technology-driven, it's policy-driven, which is a major difference. And also, it's an industrial revolution at warp speed, because it took 60 years for coal to move from being a marginal energy to being the dominant energy. It took about 60 years also for oil. But we're speaking here of a very much shorter time frame. So it's major. So we all agree on that. We all also agree on the fact that qualitatively, the macro impact will be significant. I mean, we agree on the mechanisms. We agree also on the fact that at global level, the cost of inaction, the macro cost of inaction, exceeds by far the macro cost of action. But this is true at global level. At national level, obviously, it's not the same. At national level, the cost of and the way individual country reason is starting from their national situation. At national level, the cost of inaction may be lower than the cost of action. And this is the incentive problem we're facing. And the third point on which I think we agree is that policies in this field, because precisely it's policy-driven, policies matter considerably. They matter because of the choice of instruments. We have all this debate about prices versus regulations. We have the whole issue of decisiveness. How engaged are actually governments. And we have linked to that the issue of credibility. There are, as you surely know, if you collect all the pledges to the to the IPCC, recorded as part of the COP process. Those pledges, they're insufficient to reach the net zero by 2050, which is a stated goal of most countries, the vast majority of countries. And so that's the ambition gap, if you wish. And then if you compare those pledges with the policies that are actually in place, there is another gap, which is the credibility or the implementation gap. So that's a major dimension of where policies matter, second major dimension. And for all these reasons, the investment gap at present, private investment gap in energy is very significant. So investment into fossil fuels are about at the level, globally, about at the level where they should be in a net zero scenario. But investment into renewables are far from being where they should be. So that's the situation, and this creates all sorts of instability and volatility in the global economy because this impact the energy market and makes the energy prices highly volatile. So that's where we agree, I think, and you'll tell me if we do agree. We disagree on the macro criticality. So is it really macro significant? I mean, I would say, Géraldine, that the Commission, or at least DG ECFIN, has a sort of more benign view, saying, all that is probably true in terms of mechanisms, but the orders of magnitude are not such that it's macro critical. The second aspect on which we disagree is a potential for disruption. We're speaking of reallocation across the board. We're speaking of labor reallocation. We're speaking of capital reallocation. We're speaking of intersectoral changes. We're speaking of interregional effects. Just met with Commissioner Schmidt, who told me there are 30 regions in Europe which are highly affected by the transformation of the auto industry. So it's a significant, obviously, dimension. So all that is something that's linked to the approach to, the degree to which the transition can be smooth. I tend to think that we shouldn't underestimate the potential for disruption, that globalization has taught us that to underestimate the potential for disruption can create a lot of dissatisfaction because people are not told and because people are not supported in the transition that needs to take place and the effort they need to make. All the discourse about the net gains from globalization, neglecting the distributional dimension, has been, I think, toxic. And in the disruption, there is also the repricing of assets, and that's something on which Alex can go back. So again, that's perhaps where I would sit closer to Alex and Géraldine having a more benign view, and Nathalie, I don't know. And then finally, there's the issue of inflation. The way I look at those issues, it's a negative supply shock. So negative supply shock, at least potentially, has an inflationary impact. And so I think that this dimension is a bit left aside in some of the simulations I've seen. So question of aggregate volatility, inflation consequences, etc. So that's my take on the debate. I just want to end by mentioning that there are two issues where we're, I think, surprisingly silent. One is a consequence for public finances. being both the direct cost of renovating public buildings, doing public R&D, etc., and the indirect cost of supporting all the agents who are not able to borrow, don't have access to credit markets, retraining workers, etc. Not to speak of obviously the cost of subsidizing companies. I mean, we have also seen that this debate has changed with the introduction of the IRA and the choice by the Biden administration to go for climate, but through very different means than compared to the EU. So we're keeping a hard budget constraints, relatively hard. They're going for soft budget constraints, and that makes a lot of difference. So that's public finances. And then the other point on which, and it's related, we are relatively silent, or the discussion has been until recently very silent, is the question of competitiveness and all the dimensions that arise from this decarbonization at different speeds and through different means. And so we do have instruments. We don't know exactly about the effectiveness of those instruments, and competitiveness is obviously a channel that can affect the European economy in a very significant way. So let me stop here, giving the floor to the other speakers. Sorry, I've been a bit long. I just want to end by saying that for those listening online, there is a possibility to ask questions via Slido, and the code is green, with or without a capital G. I would suggest Alex and then Geraldine.
Okay, great. Well, good afternoon, everybody. Thanks for having me here. I want to start with some agreement, and hopefully I'll find a little bit of disagreement. But Jean, I want to begin by praising the interim report you produced late last year. I confess I did not read it in the original French. I relied on translation, but I'm hoping I got it right. But I think I agree a lot on the macro criticality of the transition. We agree it's a huge economic structural transformation, partly or largely driven by policy, but not wholly driven by policy anymore. Actually, as much driven by technology development and changing economics of production techniques as it is by policy in some areas. But we see three channels through which the transition is potentially macro critical. You've alluded to some of them. And we look at this because we have to, as investors, assess the way the transition is playing out and the impacts it's likely to have. So I think about the transition in the same way as I think about the Federal Reserve. What is likely to happen to policy? What impact will it have on the economy? And is that reflected in market prices today? And three channels of macro criticality for us. The first is the mix of demand is likely to change radically as a result of the transition. The estimates suggest that investment will need to rise as a share of GDP by around about 2 percentage points, at least. And if you use standard models to figure out what that means for the equilibrium level of interest rates in an economy, it's about 1 percentage point on the equilibrium level of interest rates. That's unwinding a small part of the reduction in the kind of natural rate of interest that we've seen over the last 20 years. And in a way, it's quite a positive development, because one of the issues faced by many major economies, including in Europe, has been an effective lower bound problem on interest rates. The natural rate of interest was below zero. So actually a changing mix of demand with greater investment demand may actually have a slightly positive macro consequence, making it somewhat easier for central banks in particular to avoid that zero lower bound problem. But a big change in the mix of demand, we have to figure out what that means for equilibrium interest rates in particular. The second channel relates to that, but is on the supply side. So this reallocation of demand is unlikely to proceed smoothly with a reallocation of supply capacity. And the example I always use here is what happened in 2020 in the shutdowns in the United States, in particular, when they stopped going out for dinner and started buying things on Amazon. And the mix of consumer spending changed suddenly and decisively. Now, what happened? Bottlenecks, labor shortages, truck shortages, queues at the port of Los Angeles, all very well documented bottlenecks, but all with one very common cause, which is a sudden reallocation and change in the mix of demand in the economy. And interestingly, that was about a 2% of GDP shift, albeit in a very short period, with a profound effect on goods price inflation. And what we're talking about here is a similar shift in the economy, probably not in an 18-month period, over a slightly longer period, so you've got to scale it down accordingly. But it shows you that if you attempt a reallocation of resources or spending in the economy on this scale, it can have profound inflationary consequences if it happens quickly. And a lot depends, therefore, on the speed with which it happens. Third macro-critical channel, again, Jean, you alluded to this, is the cost of production, generally. How much will it rise as a result of transitioning? Now, I don't think this is largely anymore about the cost of energy production. The levelized cost on a new build basis of renewable power is actually on a par with or below new build energy generation cost on traditional energy basis. Really what this boils down to is the 20-25% of emissions that are in so-called hard-to-abate sectors. Heavy transport, heavy industry, land use. Those sectors will find it very difficult on current technologies to decarbonize in the way we're describing without a very significant increase in the cost of production. And therein lies what Jean referred to as the supply shock for the economy. If economies do drive towards net zero, which is a public policy question, if they drive there, these hard-to-abate sectors will result in an increase in the overall cost of production. Now, that results in a more challenging environment for central banks, a supply shock-driven environment. And this isn't the only supply shock in town. We're going to see labor supply shocks from aging populations. We're going to see supply chain shocks from a effectively rewiring of globalization. So I don't pretend that this is the only negative supply shock going on right now, but it is an added one, driving this new regime for central banks like the ECB and the Bank of England, making it more difficult, not impossible, but more difficult for them to achieve their inflation objectives because they have to go from being the hero of the piece to being the villain of the piece, dampening demand in the economy to keep it in line with a reduced level of supply capacity to keep inflation at target. Now, all of those things, to our mind, make this macro-critical, reallocation affecting interest rates, affecting inflation, and an increase in the cost of production. I will echo what Jean said about you've got to see this relative to the available alternative. Sounds like a pessimistic view, but it is relative to the past, but not relative to the available alternative path here. And all of this is manageable. So it's really a question of kind of honesty about it and managing it rather than throwing our arms up and either denying it or saying this can't be managed. All of this is manageable. The issue is how it's managed. And I'll stop there and hand to others. I haven't disagreed with Jean enough, I realize.
Thank you very much. Geraldine?
Yes, I had the presentation, but I don't know whether we can put it on slides with a few charts to show the result, but I don't know when it comes. Is there anybody who would put online? Yeah, okay, good. You can go to the next slide. So I think that we don't disagree that much at the end. So I wouldn't certainly not say, and the Commission has never said, I think that it's not a critical shock. It's an immense shock for the economy. The question is it's in the nuance. First is to say what are the horizon we are looking at, and when we have done it, and then I'm going to present a few of the simulation that we've done, because when you look at these type of shocks, I mean, it's very difficult to know exactly what are the impact, and one way is to look at models. Models are as imperfect as they are, but it's probably the only thing that we have, and they are based on assumptions, so this is clear. But if we look first at the long term, indeed, when we use those models, this is the Quest model, so it's a dynamic general equilibrium model, you see that the impact can be relatively limited, but that's again if you use the right policies. And here we have simulated the impact of the climate neutrality target by 2050, and what will be the impact on GDP in 2050. And you can see that if you use regulation only, then you can have an impact of 2 percentage points of GDP, which, okay, we qualify it as big or small. It's not huge, but it still is certainly very significant. But then you can reduce that, impact if you use pricing policies, and these are the dark blue here, because if you use price and you recycle the revenue that you have been using, you use it in a smart way. In particular, for example, if you subsidize capital tax reduction, which is the most distorted, but also labor tax, then you get also a more positive, a less negative impact. The second important things to mention here is that this assumption depends also on, this result depends on the assumption that we make, and in particular the technology assumption is very important. And here we have assumed in this model that there are some technological improvement, and we have modeled that in function of the past, so our experience and what we have seen. Now, you could see then the question is whether we have been too optimistic or not enough optimistic. If you look at the glass half empty, you would say, yeah, but in a certain way, you have there has been a lot of improvement, and it was like the easy, the low-hanging fruit. No, and it's in line with what you say. It's more difficult now to. We are left with the production and the sector that are more hard to abate. So that's going to be more difficult to innovate. So maybe the past is not is going to be the future is going to be less good than the past. Or you could see it the glass more half full, and saying that if you look at the past 5 years, for example, we have done in the GNR, it's my colleagues doing modeling, and they have looked and then on assumptions, and they had to improve their assumption because they realized that the fast technological the rapidity of the technological progress was much higher than they initially anticipated. So, but this remains a question. So here, using the assumption that are in line with the past, the effect in the long term is not necessarily huge on the GDP. Now, if you look at the employment, and then the other question that I think that Jean and us have debate is this indeed investment versus consumption. So what you mentioned as well, the mix of the demand, and clearly there this shock will have a negative impact on welfare. Clearly, consumption will be affected, but again, the effect depends on what are the right policy that we take. And if we take smart policies using recycling the revenue from the carbon pricing and using potentially even to some of the to compensate more the household that are the most vulnerable, which is not shown here, but that can also have a more positive impact on consumption. Now, the other question is the impact on employment, and then again, so in the long term, the model seems to suggest that the impact is not really negative, or at least it's relatively small, either smallly negative or a bit positive. But that's again at the aggregate level. But if you look indeed in the detail, and I think that's also what you have mentioned, Jean, is that not all. So first of all, it will affect some part of some jobs. These jobs are essentially the brown job. The good news is that these brown jobs are generally not a large share of the employment, around 10%, and they've been decreasing. So that explains also part of the employment, the limited employment effect. At the same time, you could say this brown job have generally a low impact, a low share of the employment in the economy, but in some country in particular, these are very large. So here we will see, so even though at aggregate level the employment effect is going to be limited, in some country, in particular in some region, you could have very large effect in some region where you still have coal, you still have mine, and so on and so forth. So that is clearly important also for our policies, and that require, and we have done a paper recently on looking at all these aspects, and one of the aspects that is also interesting is to say that those brown jobs are generally low qualification jobs, so which means that generally it is more difficult to train them, So that's another negative aspect. At the same time, when we look at the evolution of this brown job over time, there has been decreasing, in particular in these regions as well, and the effect on unemployment was not. So there is no correlation between the fact that we've reduced this employment in these brown job and an increase in unemployment. So it seems to me that probably, I mean, if we look at the past, this transition is manageable. At the same time, the size will be, and probably the rapidness could be larger. But so on employment is again, so it's a bit a nuance at aggregate level. No large impact, but at regional, local level, still some impact, and clearly a call for the transition, to help the transition in terms of policy making, looking at skill, looking at active labor market policy, and so on. And my last slide is on the effect on the productivity, because it's also one of the questions. So is this green transition going to improve or deteriorate the productivity? If you think about it at a given technological change, this transition will be negative on labor productivity. You'll have massive reallocation of capital, so the capital will have to be depreciated, and new capital will need to be built. You will have also this impact on the dequalification of some of the skills. You will have impact on the fact that if you have more costly energy input, that will impact also on the productivity. So generally, this is negative. But that's when you look at a given technology. But at the same time, studies have shown that the regulation has generally a positive impact on technology. So, and you have different argument for that, saying that, and the OECD has found that I think 30% of the recent technological improvement were generated by this the regulation regarding the green transition. So we have, and this, in fact, if you look at these two elements, so the negative impact at technology given, but the fact that this regulation is going to generate probably technological improvement. And you see that if you look at the data, you see that the net effect is positive, in the sense that I show here two graphs, you have like a positive correlation generally between the energy, the emission intensity and the labor productivity. And this is seems to be essentially driven by the fact that you have higher energy efficiency in the country, which is then driven by technology improvement. So there is some hope in them, at least in terms of the productivity. And my last point is on inflation, where here, if we look again at the model, what we see is that clearly there is a negative supply shock, but there is also a negative impact on the demand here, because consumption is largely decreasing. You have some increase in investment, but overall there is a decrease in the demand, and the impact on the demand dominate the impact on the supply. So in our modeling, at least, this is rather deflationary than inflationary. And I'm just going to stop here. Thanks.
Thank you very much. Can we see? Yes, Nathalie, the floor is yours.
Thank you, Jean. Thank you for having me. I hope you're hearing me correctly, and sorry for not being with you. I will have a slightly different view on this issue of green or not green, about the impact of climate on macroeconomic factors. I'd like to give you the point of view of a national public development bank, but also of a major asset owner, which is a Caisse des Dépôts group. As an institutional investor, we put a lot of emphasis on macroeconomic framework, and we base our financial forecast, our investment strategies, even our prudential models on macroeconomic framing. And so, of course, we're very much implicated and very much eager to finance ecological transition in France and to contribute to climate issues. But one can note that if climate issues are not integrated in macroeconomic framework, institutional investors, banks, financial actors will not really reallocate their investment according to these signals. and to the impact of climate on all the economic indicators. And so I would like to really put the emphasis on the fact that we do need to integrate climate issues in macroeconomic analysis if we want to really reallocate investments and speed up the implementation of climate goals at the EU level. And what we can experience is that these economic signals are not quite efficient right now for financial institutions. We can observe on the markets that well, investments and financing in the very emissive sectors are still very high. If you take the oil sector, these investments have been rising since the adoption of the Paris Agreement. And so there are different drivers that can change that, of course, public policies for sure, but also the integration of climate issues into these economic rationales, and not only on the basis of scenarios like in the paper that is presented by Bruegel, that take the assumption that carbon neutrality will be reached. So not only on the basis of scenarios of climate transition towards net zero by 2050, but what we need is macroeconomic analysis of the business as usual in order to trigger investment reallocation. And this is well noted and underlined in the paper. What we would need is to also to have a macroeconomic analysis of what would be the impact of scenarios where we would not be on a 1.5 degree alignment, scenarios of 2 degrees, 3 degrees, impacts on macroeconomic indicators. I know how complicated it is to do this, but there are some initiatives that are emerging at the EU level because the financial regulators have put an obligation towards banks to include physical risk in their models. And this is a great driver in order to reallocate investments. So basically, I trust economists about whether climate has an impact or not on macroeconomic factors. What I would like to really emphasize is the need to really integrate these climate issues in macroeconomic models, but rather on the consequences of not reaching a net zero scenario.
Thank you. So let us take about 10 minutes for debate and then open the floor. I'd like to go back to a point that was made by Geraldine on the choice of instruments. So basically, your simulations show, and I don't dispute that regulations are a much more costly way of organizing, triggering the transition than price instruments, which can be the procedure of which can be redistributed in different ways, etc. The point is that it's not the world we're in anymore. I mean, you can, normatively, I can agree. I would have a nuance on the credibility of price signals in the kind of world we're in, because I think that the value of having regulations is that they are more credible, they're taken more seriously by industry. Although they are not, they're not 100% credible, and there are multiple cases in which governments backtrack on regulation, etc. But let's say there is a slight advantage that you didn't take into account. But fundamentally, that's not the world we're in. I mean, the EU has a mixed strategy, and the US has a strategy that does not rely at all on carbon taxation, that does not rely actually on regulation, that relies exclusively on subsidies. So basically, you know, they have a soft budget constraint, and their bet is that by subsidizing industry, they will trigger technical change. So that's the first point I wish to discuss. You know, what if we move closer to reality? How does it affect the analysis of the macro consequences?
That's of course a good point, but I wouldn't say that we are in a world only in regulation. I mean, we have both, as you said. So we have indeed a lot of regulation, like CBAM. You have the ETS that has been increased, and so. But we have also a regulation target and so on and so forth. So we try to build the two. I think that I wouldn't say that the regulation is necessarily more credible, but they are more easy to be accepted by because pricing is very difficult. And we saw it in the recent crisis, because even at Commission level, we tried in this increase in the energy prices. Most of the government, what they have done is to reduce the price. While we have, and so we try to engineer, then we managed to, even at having a recommendation agreement in the Eurogroup saying we shouldn't do price, we should do income, or at least target it. But that's on paper, but in reality, there was the majority of all the measures that have been taken. I think that more than 80% of the measures were in fact pricing. Now they are reducing them, and so we are in a world where the price has decreased, and so they are stopping these measures. But it's true, and some of them are a bit more targeted. But that's clear that so there is this issue that these measures. In terms are not necessarily the regulation, the price are not necessarily very popular. Now, when you say EU versus the US, I think that we have also, I mean, our mix is larger than you say they are subsidized and we not. It's not true. I mean, we have the three. We have the regulation. No, you said that they are subsidizing, but we are subsidized as well. That's true. Yeah, we use the three, but I think that if you compare just even the subsidy, when you look at the RA, in net term, this is revenue increasing according to the US. So it's not well, and then you would compare, for example, what we have done in the RF, which is, I mean, a recovery and resilience facility, largely done for the green transition, and here, and this is completely positive in terms of there is no. I mean, at some point, and if it doesn't work, at some point there will be an increase in the contribution from the member state to the budget. But at this stage, this is completely supportive to the industry. So I think when you put these things in perspective, so we are not that bad in the EU. But I agree with you that if we would, and we haven't done, I guess, but we could do a mixed simulation where we have half regulation and half. Basically price impact, and even taking the more clever, we will have more negative impact in growth. But I think that the issue is not necessarily the long term. The problem is the transition, really, where here in the transition there are many challenges that we have to face, and that I think we all agree that we are not there.
Subsidies is a point actually made in the Bruegel paper about the comparison between the US and Europe. Alex?
To add to that, I totally agree. I agreed with you too much earlier, so now I'm going to agree with Geraldine. That when you line head to head, the amount of money on the table through US legislation, Inflation Reduction Act, Infrastructure and Jobs Act, CHIPS Act, and compare it to the acronym soup of European facilities on offer, actually, the US package looks much simpler, but it's not as big. So I think Europe is acting on more sides of this triangle of regulation, subsidy, and carbon pricing, and it also has more money on the table on the subsidy angle as well. I think so. It's the Inflation Reduction Act is a game changer. The European package as a whole is a game changer as well, in our view. The US subsidies are not capped. No. So a lot depends on the uptake, but reasonable estimates of how big the uptake could be suggest about 2% of GDP. Big number. Add up all the European numbers in the acronym soup, we think we can get to about 4% of European GDP. So totally agree with you that there's actually more on the table. I would just make a couple of other points. The first is, regardless of method of policy, whether it's regulation, carbon pricing, fundamentally the cost of production in hard-to-abate areas in particular will rise, whichever policy is used. And that, to me, is the supply shock that we should be looking at here. The interesting question in terms of how big that supply shock is how technology develops. And I think, Geraldine, you alluded to the fact that technological progress has been incredibly rapid in some areas over recent years. And the estimates of the size of the hard-to-abate sector have shrunk from about 1/3 of emissions to about 20% of emissions as technology has developed. So I don't think we should underestimate the future development of technology in these areas. But the interesting public policy question there is, how is public policy being directed to accelerate that technology development? And for us, one of the most interesting features of the Inflation Reduction Act is the subsidy for clean tech development and hydrogen hubs and other early stage risk-taking opportunities. That's because if those technologies accelerate in their development, that hard-to-abate sector shrinks as a share of emissions, and the likely scale of the overall supply shock that we're looking at from transition gets correspondingly smaller, or continues to get correspondingly smaller.
Do you want to make a point? Nathalie?
I mean, one of the question was, what is the hardest part to achieve in order to achieve this this climate transition, and whether emphasis should be put on the regulation or on the price signal. Well, of course, the solution is a combination of all these tools. But what we can experience on our part is that, in the end, the financial part and the investment part is becoming to be achieved. Financing are flowing. I mean, at the EU level, at the national level in France, companies and actors that are in the transition sector can find financing. Now, the issue is to have projects emerge, and the only way to have projects emerge is to have a regulation adapted. We could see it in the car industry or in the real estate sector. Investment were really triggered once we had a regulation putting a ban on that will put a ban on thermic vehicles by 2035, and that is the same effect in the real estate sector, because in the end, what really make a change is to have this issue be totally inserted in the economic rationale of investors, and in the absence of a real price signal. Regulation play definitely a significant role. But so, in the end, now financings are on the table. We need the regulation signal and a price signal that can really reveal the fact that assets in the emissive sectors would be stranded. And for the moment, these signals are not strong enough, which explains that investors are still investing in high emissive companies, and which also explains the fact that shares of companies that are quite emissive are still rising. So this is the hardest part, according to me.
Thank you. Let me open the floor first from the audience. Yes, please. Yeah.
Hi, I'm here, Oliver Kim. I'm the Brussels correspondent for the Austrian newspaper Die Presse. There was an agreement in trilogue tonight on these green bonds, so the voluntary standard on green bonds. Would that be a price signal, in your view, that would encourage investors in a significant way to pour more money into the transition? And If yes, why? And if not, what else needs to be done about this? Thank you.
Thank you. Another one, Yeromin?
So I think from the two opening presentations, it became clear that if we think of the impact of decarbonization on the economy feeding through in a gradual and predictable way, which I think is more or less what the Quest model generates, the effects are really small, and because I think, if I understood correctly, this is a 2% level effect in 2050, right? So this is less than 0.1% growth per year. This is about equivalent to the permanent loss of an average recession. It's really small. And also Alex was emphasizing a lot that, you know, whether or not there's an inflation impact depends on how condensed transformation is, right? So I think the baseline idea is that, look, this is all highly anticipated. This is not sudden. There's no surprise element. This is the most anticipated change in supply structure in the history of the universe. And so unless there's some sort of accident, actually the effects might be very small, and they are completely dwarfed by the climate risk of actually not hitting those decarbonization targets. Right, then there's one main caveat, I think, and the caveat is, so this reaction in supply will only happen smoothly in a way that is consistent with the Quest model if decarbonization is actually credible. Right, so in a sense, the worst thing that could happen is sort of this half-credible carbonization, which is actually the point that Natalie just made, where, you know, half of the business world doesn't take it seriously. And at some point, there's a realization, oops, actually it has to be taken seriously, and then we arrive at the bottlenecks. And so I was wondering whether the panel could react to that, because on this we should have empirical evidence, right? So how credible is decarbonization in Europe, for example?
Thank you. Let me go back to the panel, but mentioning, and that also echoes Yeromin's comment. I had a lot of questions from my clerk, but one of them being that the NGFS simulations, he criticizes them for being weak and uncertain, but that echoes exactly what Yeromin said, because the NGFS simulations, the Network for Greening the Financial System, which is, you know, the network of central banks, they basically start from this assumption that if well managed, the cost of the transition will be very small, but if not well managed, it could be very high. So that's something on which I think it would be interesting to hear the reaction from Alex, especially as you come from the Bank of England.
Can't get away from it.
But also Geraldine and Natalie.
Okay, a couple of thoughts then. So I do think kind of half of the supply side cost that I'm broadly characterizing here reflects the speed and orderliness of the transition, and that's the need for the reallocation of resources to take place over time so that the supply side of the economy can keep up. And if that happens over a multi-decade period, it's likely to be very low cost. As you say, it's kind of very well signaled. I do think it does rely on credibility, because the supply side will only shift if it sees kind of profit opportunities ahead. And I think given the changes in public policy that we're looking at here, plus the technology developments that we talked about, actually, I think a lot of the transition is credible just from a purely dispassionate kind of economic view. Taxes have changed, subsidies have changed, technology has changed. The supply side is therefore adapting in the same way as it adapts to any other technology or policy development. So I think it's credible in that sense. But what you're left with is this kind of irreducible supply side impact right now of these hard to abate sectors for which there is no current technology. It will require what I think you called in your report a degree of sobriety and demand restraint in order to reduce emissions, unless there is some technological breakthrough. But given where we are right now, I think you're still left with a supply shock in that area, which, you see estimates that to decarbonize those sectors, or to provide incentives to decarbonize those sectors and reduce demand, would require a carbon price maybe twice the level of what's trading in the ETS right now. That's a big supply shock in those sectors. And I think you're left with that right now, however orderly you are. I just, one other point on market reaction. I think markets are pricing a lot of the transition that's ahead of us. We've seen over a multi-year period now a repricing of securities depending on their kind of preparedness for the transition, which is a normal pricing of risk. If this economic structural transformation is happening, and it is credible to a degree, investors are reacting by looking at a security and asking, well, is it poised to thrive or not in such a transition? And we see that when you dig down into analysis of risk premia on individual securities, we see that emerging over a multi-year period, which I think speaks to the credibility point.
How do you interpret this evolution? I mean, with respect to credibility, because if policies are not credible, then investors are exposed to two types of shocks. One is the climate shock, and the fact that it doesn't take place. But the other one is the credibility shock, that the investors and companies invest assuming that policies will be put in place, but policies in the end backtrack.
Well, I
don't deliver.
I think two things have happened. One is that policy has actually changed across a number of very important jurisdictions now. China, US, Europe, all very big policy developments on this front. So it's not a question of so much now of belief in future action, but actually that the actions taken to date have been very big. The other, as I say, is that technology development has meant that even aside from policy, the economics have shifted decisively. So as a company now, you're looking at these developments, and it's less a question of future credibility and more a question of it's actually happening. And investors are looking at that and thinking, well, company X is perhaps prepared for the transition, it's poised to benefit from it, its risk premia will be somewhat lower. And we see this relative pricing happening over a number of years, which suggests to us that things are being priced based on a degree of credibility of current and future actions.
Charlie?
What's reassuring to hear that at least in the market they're believing what we are trying to do. No, I think that, yeah, on I would, of course I'm biased because I'm coming from the Commission and we are the one putting these regulations in place, but I think the fact that we are doing it at European level or even at global level makes it much more difficult for changing these regulations. It's difficult to agree on them, but then when they are in place, it's also more difficult to change them. So I think that hopefully the market, it's good that even the financial market, but I think the industry knows that these ETS, this is there to stay, that the CBAM is there to stay. So I don't think that there is a credibility issue there. But of course, this is not sufficient. I mean, we're not going to, and as you said, so if you would want to really push the market and push the actor to do much more, we will need to increase the price much more, which is politically very difficult. So there are other things that need to be done. And that's maybe where the jury is maybe out, in particular in the investment and so on and so forth. But I think also the Russian crisis, and in particular, I mean, and we've always said that there is lots of investment to be put into place. Part of it can come from the public sector, but only a part of it. So a large part needs to come from the private, and that's where indeed we have to see that these investments are going to come, and there is a role for policies to make sure that they are there. And again, the role of the regulation constraining this and gearing them is very important. And I think the last element is also the consumer reaction. So in here, I think the Russian, as the Russian invasion of Ukraine had some impact in terms, at least. Now, of course, the problem is that the price is going down, which is good from an economic point of view, but not as good in terms of reaction. But that has also, in my view, helped to sensibilize much more the population about all these risks and the need to act now. So that from that point of view, that may also have added some sort of credibility, or at least sense of urgency of what was seen as something for like 20 years, and now it's something for now, the climate change as well. So I think there is also a general sensibilization. At least when I talk to my kids, they're talking to me about all this all the time, where I can tell you at that age I didn't give a damn about that.
Nathalie?
Yes, well, on the NGFS scenarios, what we can experience is that, well, they're very important as regards the assessment of climate risk, of course. And as many other financial institutions, we have used them in order to assess our portfolio exposure to climate risk, especially on transition climate risk. And so we have used them in order to implement stress tests on our portfolios. And what we've learned from this scenario is that, well, in the end, the impact is very slight. Maybe not because we are not exposed to climate risk, but because the NGFS scenarios are not very stressed. In fact, the hothouse scenario corresponds to the disordered scenario, the one which would not be the normal scenario in stress tests. And whereas, I mean, the hothouse scenario is the one that we are experiencing right now. At the global level, according to goals that have been set by signatories of the Paris Agreement, we are not on a 1.5 track, as you know, and so in the end, we would need much more stress scenario, and in order to really have an impact on investment reallocation. And I think this is crucial if we really want to, to have this investment shock that is described in the paper.
Okay, I think we're coming to the end. There's one question here I don't want to let go.
Thank you. Christian Guimès from Trifin Foundation, University of Louvain. I would like to go beyond the EU policies with the global aspect of the financial flows. All these scenarios suppose that we would be able to organize the Paris Agreement. That means to have, at least for the emerging and the LDCs, to have 1 to 2 trillion per year of financial flows. My question is, would the present dollar system allow this to be feasible due to the fact that the South is financing consumption in the North, especially the Anglo-Saxon countries?
Would you like to take it?
It's always the last question that's the killer, and it's a great question. I think this is a somewhat overlooked aspect of the global transition. There is an assumption generally in models, partly because the scenario is assumed, and then it's worked backwards, that capital will flow to where it needs to go. And on our calculations, less developed economies' financing needs are vast compared to current capital flows. And so for us, one of the things we're monitoring and watching very closely and thinking about how the transition will develop is how the institutional structures are set to develop over time. See the debate about the World Bank now, in order to potentially encourage financial flows to those places, because on historical performance, they will not be big enough to generate the kind of investment needs in those markets. So it's an important thing to monitor when thinking about how the transition globally is set to evolve.
We discussed, you raised this question before, and I have no great answer, but I think thinking about it, I think that the the assumption you make is that, okay, capital is not constrained and goes wherever, but we are trying exactly to do the opposite. So I think that when those agreements are to forcing the investment where they would naturally not come. So in a certain way, I don't see necessarily a full contradiction in the sense that what we're trying to say is to engineer something that would naturally not happen. And that's maybe one reason of the problem.
Yeah, we are assuming that the transition will be policy driven, that it will be driven by essentially national policies, that the logic of the Paris Agreement, that countries determine by themselves their target, and therefore that the way it should be working and the financial flows, as you said, will be following. The problem is that it may not be true. It may not be true that developing countries have sufficient reasons, incentives to behave in the right way, and they may just want to look, and they've insisted on the financial flows, 100 billion committed by the rich countries, and that's just part of the need. Obviously, that's public money. That's not the whole of the investment flows, and so that's clearly an underappreciated dimension of the problem.
Yeah.
Okay, I think we should conclude here. As usual with the panel, we started with some perception. They've changed a bit, not entirely. There are some issues for discussion that remain, but we understand better where we disagree and why. Thank you. Thank you to all.
Thank you.
How do I get